For a long time, corporate strategy followed an optimistic script. Leaders started with upside scenarios: market expansion, demand growth, scale efficiencies, and long-term competitive dominance. Risks were discussed, but usually as footnotes. The core strategy assumed things would mostly go right. Today, that order has reversed. Across corporate America, strategy is being written for the downside first, and only then adjusted for upside. This shift is not cosmetic. It reflects a fundamental change in how companies define success, failure, and survival. Corporate strategy is being written for the downside first, because the cost of being wrong has risen faster than the reward for being right. The most important driver behind this change is prolonged uncertainty. In earlier cycles, downturns were sharp but temporary. Companies could plan through them with confidence that normal conditions would return. In the current environment, uncertainty doesn't resolve cleanly. Interest rates, inflation pressures, geopolitical risks, regulatory changes, labor markets, and technology disruption are all moving at once. When uncertainty becomes permanent rather than episodic, strategies that assume stable conditions become fragile. Writing strategy for the downside first becomes a form of insurance. Another major factor is how capital markets now respond to risk. Investors are no longer rewarding bold long-term visions without near-term credibility. A single missed forecast, margin surprise, or cost overrun can erase years of perceived value. Markets punish downside far more aggressively than they reward upside. As a result, boards and executives design strategies that aim to avoid visible failure before chasing growth. Protecting against downside scenarios has become a primary objective. Internal governance has also shifted. CFOs and risk committees now play a central role in strategy formation. Before a plan is approved, it is stress-tested against recession scenarios, demand shocks, financing constraints, and execution delays. If a strategy cannot survive a downside case, it rarely moves forward. This doesn't mean companies expect the worst to happen. It means they refuse to commit to plans that break easily. Forecast reliability has weakened as well. Demand patterns change faster. Customer behavior is harder to predict. Technology cycles compress timelines. When forecasts lose precision, strategies built on aggressive assumptions become liabilities. Writing strategy for the downside first reduces dependence on optimistic projections. It forces companies to ask not how big an opportunity could be, but how much damage can be absorbed if assumptions fail. There is also a structural fear of irreversibility. Many strategic decisions lock companies into fixed costs, long-term contracts, or capacity commitments that are difficult to unwind. Once those decisions are made, flexibility disappears. Downside-first strategy prioritizes reversibility. Projects are designed to scale down, pause, or exit without threatening the entire organization. Growth is pursued, but only if it can be contained. Labor economics contribute to this thinking. Hiring and workforce expansion are no longer easily reversible decisions. Talent shortages, wage inflation, benefits costs, and retention risks make headcount growth a long-term obligation. Strategies now assume that labor costs may remain elevated even in downturns. Writing for the downside first helps ensure companies can carry their workforce through weaker periods without panic cuts. Debt and financing conditions have also changed strategic behavior. Higher interest rates mean leverage carries more risk. Refinancing is less predictable. Liquidity matters more. Strategies that depend on continuous access to cheap capital are viewed as fragile. Downside-first planning emphasizes cash flow resilience and balance sheet strength before expansion. Another quiet influence is reputational risk. Strategic failures are highly visible. Analysts, media, employees, and shareholders scrutinize bold moves closely. When a strategy fails, the narrative can damage leadership credibility for years. By contrast, conservative strategies rarely attract criticism. This asymmetry pushes companies toward downside protection as a reputational shield. Importantly, downside-first strategy does not eliminate ambition. It reshapes it. Instead of one large bet, companies pursue a portfolio of smaller, staged initiatives. Instead of committing early, they wait for validation. Instead of optimizing for maximum growth, they optimize for survivability. Cash buffers, flexible supply chains, modular operations, and diversified revenue streams become strategic priorities. This approach also aligns with changing investor expectations. Many investors now favor predictability over explosive growth. Stable margins, consistent cash flow, and downside protection support higher confidence, even if headline growth is slower. Strategy that survives bad scenarios is increasingly seen as higher quality strategy. The result is a new strategic mindset. Companies start by asking what could break the business, not what could transform it. They design plans that can withstand stress before layering on opportunity. Growth is still the goal, but only growth that does not endanger the organization if conditions deteriorate. Corporate strategy is being written for the downside first, because the environment rewards durability over daring. In a world where volatility lingers and mistakes carry lasting consequences, survival has become a competitive advantage. Writing strategy for the downside is no longer pessimism. It is realism. And for corporate America, it is now the foundation of smart decision-making.